In this session, we're going to start talking about liabilities. We'll talk about how to account for liabilities, and those are both current and long-term liabilities. First, we'll start talking about how to account for current liabilities and contingent liabilities. Current liabilities are obligations due within 1 year or within the company's normal operating cycle if longer than a year. Obligations due beyond that period of time are classified as long-term liabilities. Current liabilities are of two kinds. One kind is of current liability with a known amount. The second kind is a current liability with an estimated amount. Current liabilities of known amount include accounts payable, short-term notes payable, sales tax payable, accrued liabilities, payroll liabilities, unearned revenue, and current portion of long-term debt. Amounts owed for products or services purchased on account are accounts payable. An important measure of liquidity for a retail business is accounts payable turnover, which means the number of times a year a company is able to pay its accounts payable. Once the turnover is computed, it is usually expressed in number of days or days payable outstanding by dividing the turnover into 365. Generally, a high turnover ratio is better than a low turnover ratio. Current companies with shorter payment periods are generally better credit risk than those with longer payment periods. However, some companies with strong credit ratings strategically follow shrewd cash management policies, withholding payment to suppliers as long as possible while speeding up collections in order to conserve cash. Short-term notes payable, a common form of financing, or notes payable due within 1 year. Companies may issue a short-term note payable to borrow cash or to purchase assets. On its notes payable, a company must accrue interest expense and interest payable at the end of the period. An example will illustrate how to account for short-term notes payable. Assume a company purchased $30,000 of inventory on December 1 by signing a 3-month 9% note payable. Inventory is debited and note payable is credited. On December 31, their year-end, interest needs to be accrued. The principal of the note is multiplied by the interest rate by 1/12. The fraction represents the 1 month the note has been outstanding. Interest expense is debited and interest payable is credited. On March 1 of the following year, payment of principal and interest is made. Notes payable is debited for the principal. Interest payable is debited for the amount of the year 1 accrual. Interest expense is debited for the 2 months of interest accrued this year. Finally, cash is credited for the entire amount that is paid to the creditor. Most states levy a sales tax on retail sales. Retailers collect the tax from customers and thus owe the state for sales tax collected. Suppose a retailer earned $100,000 in sales on a given day. The sales tax rate is 5%. Here we see the entry to record the sales and related sales tax. We debit cash because we receive cash of $105,000, and we credit sales revenue and credit sales tax payable. With respect to accrued liability, an accrued liability usually results from an expense that the business has incurred but not yet paid. Therefore, an accrued expense creates a liability, which explains why it is also called an accrued expense. For example, a business's salary expense and salary payable occur as employees work for the company. Interest expense accrues with the passage of time. There are several categories of accrued expenses: salaries and wages payable, interest payable, and income taxes payable. Salaries and wages payable is the liability for payroll expenses not yet paid at the end of the period. This category includes salaries, wages, and payroll taxes withheld from the employee paychecks. Interest payable is the company's interest payable on notes payable, and income taxes payable is the amount of income tax the company still owes at year-end. Payroll, also called employee compensation, is a major expense for service organizations such as law firms, real estate companies, and airlines, compensation is the major expense, just as cost of goods sold is the largest expense for a merchandising company. Employee compensation takes many different forms. A salary is employee pay stated at a monthly or yearly rate. A wage is employee pay stated at an hourly rate. Sales employees also earn a commission, which is a percentage of the sales the employee has made. A bonus is an amount over and above regular compensation. A typical entry to record payroll is shown here. Salary expense represents gross pay, that is employee pay before subtractions for taxes and other deductions. Salary expense creates several payroll liabilities. Employee income tax payable is the employee's income tax that has been withheld from the paychecks. FICA tax payable includes the employee's Social Security tax and Medicare tax, which also are withheld from paychecks. And salary payable to employees is their net take-home pay. Unearned revenues are also called deferred revenues and revenues collected in advance. For all unearned revenue, the business has received cash from customers before earning the revenue. The company has a liability or an obligation to provide goods or services to the company. When the company receives payments before service is provided or product is sold, cash is debited and unearned revenue is credited. Later, when the revenue is earned, unearned revenue is decreased or debited and revenue is recorded or credited. This is often done through the adjusting process we spoke about earlier. An example here using exercise 9-17.8 may help clarify. Worldwide Publishing completed the following transaction for one subscriber during 2012. So the date, October 1, Worldwide Publishing sold a one-year subscription collecting cash of $2,400 plus sales tax of 9%. And so we debit cash of $2,616. We credit unearned subscription revenue for $2,400 and credit sales tax payable. So we're crediting unearned subscription revenue because it was paid in advance. We have a liability to deliver a subscription. On November 15th, we paid the sales tax to the state of Massachusetts. So we debit the sales tax payable because we're reducing that liability, and we credit cash because we're reducing that asset for the $216 or the amount of sales tax. And then on December 31, we made a necessary adjustment to unearned subscription revenue. We had provided the service for 3 months, so 3/12 times the $2,400 or the annual amount resulted in a debit to unearned subscription revenue and a credit to subscription revenue. Some long-term debt must be paid in installments. The current portion of long-term debt, also called current maturity or current installment, is the amount of the principal that is payable within 1 year from the balance sheet date. At the end of each year, a company reclassifies from long-term debt to a current liability the amount of its long-term debt that must be paid next year. A business may know that a liability exists but not know its exact amount. The business must report the liability on the balance sheet when the amount can be reasonably approximated. Estimated liabilities vary among corporations. The most common estimated liabilities include estimated warranty payable and contingent liabilities. Many companies guarantee their products under warranty agreements. The warranty period may extend for 90 days to a year for consumer products. Whatever the warranty's life, the matching principle demands that the company record the warranty expense in the same period that the business records sales revenue. After all, the warranty motivates customers to buy products, so the company must record warranty expense with the revenue. At the end of the sale, however, the company doesn't know which products are defective. The exact amount of warranty expense cannot be known with certainty, so the business must estimate warranty expense and the related liability. To record estimated warranty liability, an entry is made debiting warranty expense and crediting estimated warranty liability. The amount is established based on prior experience or industry standards. When actual warranty work is performed, the liability is debited and inventory is credited for any parts used. A contingent liability is not an actual liability. Instead, it's a potential liability that depends on the future outcome of past events. Examples of contingent liabilities are future obligations that may arise because of lawsuits, tax disputes, or alleged violations of environmental protection laws. The principle of representational faithfulness requires that companies disclose the substance of their financial position and results of operations in a way that is transparent and complete as possible. With liabilities, that principle says, when in doubt, disclose. When necessary, accrue. The Financial Accounting Standards Board, or FASB, provides these guidelines to account for contingent liabilities. Accrue for a contingent liability if it's probable that the loss or expense will occur and the amount can be reasonably estimated. An example is a lawsuit that's been settled as of the balance sheet date but it has not yet been paid. Disclose a contingency in the financial statement note if it's reasonably possible that a loss or expense will occur. Lawsuits in process or progress are a prime example of this. There's no need to report a contingent loss that is unlikely to occur. Instead, wait until an actual transaction clears up the situation. And so next we want to account for bonds payable, notes payable, and interest expense. We now move on to long-term liabilities, which are bonds payable and notes payable. Each bond payable is in effect a note payable. Bonds payable are debits of the issuing company. Purchasers of bonds receive a bond certificate which carries the issuing company's name. The certificate also states the principal, which is typically stated in units of $1,000. Principal is also called the bond's face value, maturity value, or par value. The bond obligates the issuing company to pay the debt at a specific future time called the maturity date. Interest is the rental fee on borrowed money. The bond certificate states the interest rate that the issuer will pay the holder and the dates that the interest payments are due. This is generally twice a year. Issuing bonds usually requires the services of a security firm to act as the underwriter of the bond issued. The underwriter purchases the bonds from the issuing company and resells them to its clients, or it may sell the bonds on behalf of the company to its clients and earn a commission on the sale. All bonds in a particular issue may mature at the same time, like term bonds, or in installments over a period of time, like serial bonds. Serial bonds are the installment notes payable. Secured or mortgaged bonds give the bondholder the right to take specific assets of the issuer if the company defaults, that is, it fails to pay interest or principal. Unsecured bonds, called debentures, are backed only by the good faith of the borrowers. Debenture carries a higher rate of interest than secured bonds because debentures are riskier investments. Investors may buy and sell bonds through bond market. Bond prices are quoted at the percentage of the maturity value. A bond issued at a price above its face or par value is said to be issued at a premium, and a bond issued at a price below face or par value has a discount. Premium on bonds payable has a credit balance, and discount on bonds payable carries a debit balance. Since bonds payable is a liability account, premium on bonds payable is also a liability, and discount on bonds is therefore a contra liability account. As a bond nears maturity, its market price moves toward par value. Therefore, the price of a bond issued at a premium decreases toward maturity value. The price of a bond issued at a discount increases toward maturity value. On the maturity date, a bond's market value exactly equals its face value because the company that issued the bond pays that amount to retire the bond. Bonds are always sold at their market price, which is the amount investors will pay for the bond. Market price is the bond's present value, which equals the present value of the principal payment plus the present value of the cash interest payment. Interest is usually paid semi-annually or twice a year. Some companies pay interest annually or quarterly. Two interest rates work to set the price of a bond. The stated interest rate, also called the coupon rate, is the interest rate printed on the bond certificate. The stated rate determines the amount of cash interest the borrower pays and the investor receives each year. The market interest rate, or effective interest rate, is the rate that investors demand for loaning their money. The market interest rate varies by the minute. A company may issue bonds with a stated interest rate that differs from the prevailing market interest rate. In fact, the two interest rates often differ because of the time that passes between when a bond issue is established and when it is actually sold. This table shows how the stated interest rate and the market interest rate interact to determine the issue price of a bond payable for three separate cases. Assume a corporation issues $100,000 8% 5-year bonds at par that pay interest semi-annually. On the date of issue, the company would receive cash in the amount of the face value and record bonds payable. Every 6 months, the corporation will pay interest to the bondholders. To determine the cash interest payment, multiply the face value of the bond by the stated rate and then multiply by 1/2. Interest expense is debited and cash is credited. Five years later, at maturity, the face value is returned to the bondholders, and so bonds payable is debited and cash is credited for the face value. Market conditions may force a company to issue bonds at a discount. Suppose a corporation issued $100,000 of 9% 5-year bonds when the market interest rate is 10%. The market price of the bonds drops, and the corporation receives $96,149 at issuance. The entry to record the issuance includes a debit to cash for the price received, a debit to discount on bonds payable for the difference between face value and the issue value, and a credit to bonds payable for the face value. Discount on bonds payable is a contra account to bonds payable, a decrease in the company's liability. Subtracting the discount from bonds payable yields the carrying amount of the bonds. Thus, the corporation's liability is $96,149, which is the amount the company borrowed. Immediately after the bonds are issued, the accounts would appear on the balance sheet as shown here. Notice the discount on bonds payable goes in the opposite direction as the bonds payable, which is why we call it a contra liability account. Each semi-annual interest payment is set by the bond contract and therefore remains the same over the life of the bonds. However, interest expense for bonds issued at a discount increases as the bonds march toward maturity. For bonds issued at a premium, interest expense decreases as the bonds reach maturity. Using the effective interest rate method, an interest expense is determined by multiplying the carrying amount by the market rate of interest cut in half. The information here will be used for an example on the following slide. Now we have an issue date of January 1, 2012, face value of $100,000 with a stated interest rate of 9%. That's also known as the coupon rate. The interest payments are paid semi-annually with the maturity date of January 1, 2017. We have a market interest rate of 10%, and the bonds had an issue price of $96,149. It's very helpful to set up an amortization table for bonds payable. Using the data on the previous slide, the table above shows the interest payment, interest expense, discount amortization and balance, and the bond carrying amount for each interest payment. Due to space constraints, only the first two and last interest payment dates are shown. An explanation of each column is as. So for column A, the semi-annual interest payments are constant, fixed by the bond contract, and in this example, the $4,500 is computed by multiplying the $100,000 face value by the 9% stated interest rate divided by 1/2 since they're paid semi-annually. Column B, the interest expense each period is computed by multiplying the preceding bond carrying amount by the market interest rate. Interest expense increases as the bond's carrying amount increases. In this example, the first period's interest rate is computed by multiplying the bond carrying amount of $96,149 by 5%. Again, the market rate cut in half. Column C is the discount amortization, which reflects the excess of interest expense, column B, over interest payment, column A. Column D is the discount balance, which decreases when amortized, and then column E is the bond carrying amount, which increases from $96,149 at issuance to $100,000 at maturity. This graph depicts the bond amortization table in the previous slide. The interest payment remains constant while the interest expense increases over the bond's terms. The space between the two lines represents the discount amortization. This graph shows how the bond carrying amount begins at the bond price and increases each period until it equals face value. The journal entry made each interest payment includes a debit to interest expense, a credit to discount on bonds payable, and a credit to cash or interest payable. All the amounts can be located on the amortization slide. The bonds are shown at their carrying amount on the balance sheet. The balances as of December 31st, 2012 are shown here. And so companies don't always issue bonds at the beginning or end of their accounting year. They issue bonds when market conditions are most favorable, and that may be on May 16th, August 1st, or any other date. When this occurs, a year-end accrual of interest expense must be made. To illustrate, assume a company issues $100,000 in bonds. They're 10-year bonds with 8% coupon rates, and they're issued on August 31st at 96 when the market rate was 9%. The bonds payable semi-annual interest on February 28th and August 31st each year. On December 31, 4 months of interest must be accrued. And so we see that entry here, we see the calculation of it. So let's modify the previous bond example to illustrate issuance of the bonds at a premium. Assume that a company issues $100,000 of 5-year, 9% bonds that pay interest semi-annually. If the 9% bonds are issued when the market interest rate is 8%, their issue price is $104,100. The premium on these bonds is $4,100. In practice, bond premiums are rare because few companies issue their bonds to pay cash interest above the market interest rate. The bond amortization schedule for a premium is very similar to one for a discount. The main difference is that the premium is added to the face value of the bond at issue date and subtracted from the bond carrying value as it is amortized. With the premium, the bond carrying amount decreases over the bond term until it reaches face value. Another important fact to note is that opposite of a bond issued at a discount, the interest expense is lower than the interest payment and decreases over time. This graph depicts the bond amortization table on our previous slide. The interest payment remains constant while the interest expense decreases over the bond terms. The space between the two lines represents the premium amortization. This graph shows how the bond carrying amount begins at the bond price and decreases each period until it equals face value. There's a less precise way to amortize bond discounts or premiums. The straight line amortization method divides a bond discount or premium into equal periodic amounts over the bond's term. The amount of interest expense is the same for each interest period. Generally, accepted accounting principles, or GAAP, permit the straight line amortization method only when its amounts differ insignificantly from the amounts determined by the effective interest method. Normally, companies wait until maturity to pay off or retire their bonds payable, but companies sometimes retire bonds early. The main reason for retiring bonds early is to relieve the pressure of making high interest payments. Also, the company may be able to borrow at a lower interest rate elsewhere. Sometimes bonds are callable, which means that the issuer may call or pay off those bonds at a prearranged price, which is called the call price, whenever the issuer chooses. The call price is often a percentage point or two above the par value, perhaps 101 or 102. Callable bonds give the issuer the benefit of being able to pay off the bonds whenever it is most favorable to do so, such as when the company has surplus cash on hand. The alternative to calling the bonds is to purchase them in the open market at their current market price. The difference between the cash paid to retire the bonds and the carrying value of the bonds is either a gain or a loss. Gains and losses on early retirement of bonds payable are reported as other income or loss on the income statement. Finally, some corporate bonds may be converted into the issuing company's common stock. These bonds are called convertible bonds or convertible notes. For investors, these bonds combine the safety of assured receipt of interest and principal on the bonds with the opportunity for gains on the stock. The conversion feature is so attractive that investors usually accept a lower interest rate than they would on non-convertible bonds. The lower cash interest payments benefit the issuer. If the market price of the issuing company stock gets high enough, the bondholder will convert the bonds into stock. So this concludes part 1 of this chapter. I encourage you to read the chapter closely, and we will move on to part 2. Thank you.